Imagine opening your investment account one morning and seeing $500,000, $500,000. For many people, that number feels like the moment they've finally made it. But what actually happens when your investments reach $500,000? Can you retire? How much income can it potentially generate? Does your money finally start working harder than you do? And perhaps most importantly, how different does your financial life become after reaching this milestone? The answer is more interesting than simply saying, you're halfway to becoming a millionaire. Because $500,000 can represent a major turning point in your financial journey. Your investments become large enough that normal market movements can create tens of thousands of dollars in gains or losses. Compounding becomes much more powerful. Your relationship with work can change, and your financial decisions can start shifting from building wealth to protecting and using wealth intelligently. So in this video, we're going to look at 10 major things that can happen when your investments reach $500,000. Let's begin. 1. Your investment returns start becoming significant. When you're starting with $5,000, investment growth can feel almost invisible. Imagine, purely as an example, your portfolio earns 8% in a year. On $5,000, that's about $400. Helpful? Yes. Life-changing? Probably not. Now imagine you have $100,000 invested. That same hypothetical 8% return would represent around $8,000. That's much more noticeable. But now take that same 8% and apply it to $500,000. That's approximately $40,000. And suddenly, the mathematics feels completely different. You're still earning the same percentage, but you're earning it on a much larger amount of money. This is one of the most important principles of long-term investing. Your investment returns are percentages, but your wealth is measured in dollars. As your portfolio becomes larger, relatively ordinary percentage movements can create increasingly large dollar amounts. Of course, the market doesn't guarantee an 8% return every year. One year could be positive. Another could be negative. You could experience a recession or a major market crash. But the basic principle remains. A larger portfolio gives compounding more capital to work with. And that's why reaching $500,000 can feel like crossing an invisible line. You're no longer relying only on your paycheck and monthly contributions. Your existing investments can become a major engine of your wealth-building journey. 2. Your money can start doing more VHE work. Let's imagine two investors. Investor A has $20,000 invested. Investor B has $500,000 invested. Both experience the same hypothetical 8% return. Investor A generates approximately $1,600. Investor B generates approximately $40,000. Investor B didn't work 25 times harder. They didn't make 25 times as many investment decisions. They simply had more capital working for them. And this is where something important starts happening. Eventually, your investment growth can become larger than your annual contributions. Imagine you're investing $1,000 every month. That's $12,000 per year. Now imagine your $500,000 portfolio experiences an 8% hypothetical return. That's around $40,000 of growth. Your contribution was $12,000. The hypothetical investment growth was more than 3 times that amount. Again, real investment returns are unpredictable. You might earn nothing in a particular year. You might lose money. You might earn much more. But the concept is powerful. Once your portfolio becomes large enough, your money can potentially become a bigger contributor to your wealth than your monthly savings. This is one reason people often feel that wealth starts accelerating after certain milestones. It's not magic, it's mathematics. 3. $500,000 doesn't automatically mean financial independence. Here's where people often get confused. Someone says, I have $500,000 invested. And immediately someone asks, so, can you retire? Not necessarily. Because $500,000 means very different things to different people. Imagine one person spends $30,000 a year. Another person spends $100,000. Both have $500,000 invested. Their financial situations are completely different. The first person may be much closer to financial independence. The second may still need many years of employment. That's why the better question isn't, is $500,000 enough? It's, enough for what lifestyle? Your financial independence number depends on your expenses, housing, healthcare, food, transportation, taxes, family responsibilities, travel, and the lifestyle you actually want. If your annual expenses are low, $500,000 can potentially provide a meaningful amount of financial security. If your lifestyle is extremely expensive, the same $500,000 may not go nearly as far. So don't compare your number with someone else's. Your financial independence number is personal. 4. Compounding can turn $500,000 into something much larger. Now we get to the really exciting part. Imagine you reach $500,000 and then you simply leave the money invested. No additional contributions, no extra deposits, just time. For illustration, let's assume an average annual return of 8%. At that hypothetical rate, $500,000 could roughly double to $1 million in about 9 years. And if it remained invested for 20 years at that same hypothetical rate, it could mathematically grow to around $2.3 million. But there's a very important warning. This is not a prediction. Markets don't provide a smooth 8% every year. You could experience several years of poor performance. You could experience a major crash. Inflation can reduce purchasing power. Taxes and fees can reduce returns. And withdrawals can dramatically change the outcome. But the illustration teaches us something important. Once you've accumulated a large investment base, time becomes extremely valuable. You don't necessarily need to chase spectacular returns. You may simply need to give your capital enough time to compound. This is why reaching $500,000 isn't just about the amount you have today. It's about the future growth that amount could potentially create. 5. Market loss become mush bigger in dollar terms. There's a downside to having a larger portfolio. Your losses become larger too. Imagine your $500,000 portfolio falls by 20%. That's a decline of $100,000. Your account could temporarily fall to approximately $400,000. Now imagine seeing that number after spending years building your portfolio. It can be terrifying. When your portfolio was worth $10,000, a 20% decline meant $2,000. At $500,000, the exact same percentage represents $100,000. The percentage didn't change, but the emotional impact can be dramatically different. And this is why investing becomes increasingly psychological as your wealth grows. You need to understand that markets don't move in straight lines. If you own diversified investments intended for long-term growth, temporary declines can happen. But diversification doesn't eliminate risk. Individual investments can permanently lose value. Businesses can fail. Markets can remain depressed for long periods. That's why you need an investment strategy that matches your goals and your ability to tolerate volatility. Because the biggest danger isn't necessarily a market decline. It can be your reaction to the decline. If you panic and sell everything during a crash, you may turn a temporary decline into a permanent loss. 6. Your relationship with your job can change. Reaching $500,000 can also create a psychological shift. You may still need to work, but you may no longer feel completely trapped by your job. Imagine you're earning $80,000 a year. You have $500,000 invested. Your investments aren't necessarily generating enough sustainable income to replace your salary. But you now have something valuable, a financial cushion. Maybe your company offers you a promotion that requires dramatically longer hours. Previously, you might have thought, I have to take it. Now you might think, is it actually worth it? Maybe you hate your job. Previously, quitting might have seemed impossible. Now you may have enough assets and savings to give yourself more time to search for something better. Maybe you want to start a business. Maybe you want to change careers. Maybe you want it to work part-time. Maybe you want to take a 6-month break. Your $500,000 portfolio may not give you complete financial independence, but it can potentially give you something extremely valuable, options. And sometimes financial freedom begins before you actually become financially independent. It begins when you gain the ability to say no. 7. You may start thinking more about preserving wealth. When you're building your first $50,000, your main question might be, how can I grow this faster? At $500,000, the question can become more complicated. You may start asking, how do I protect what I've built? That's an important transition. You may become more interested in diversification, asset allocation, taxes, investment fees, emergency reserves, insurance, retirement accounts, estate planning, and overall risk management. Why? Because losing a large amount of money can have a much bigger impact than losing a small amount. This doesn't mean you should stop taking investment risk completely. If you're young and have decades ahead of you, avoiding all risk could also create problems because inflation can erode purchasing power. Instead, the goal is to understand the relationship between risk, return, time, and your personal financial goals. The investment strategy that helped you build $500,000 might not necessarily be the exact strategy you want when you're approaching retirement. Your financial strategy should evolve as your circumstances change. 8. Lifestyle inflation can become your biggest enemy. Here's a trap that catches many people. You reach $500,000. You start feeling successful, and then your lifestyle expands. Maybe you buy a more expensive car. Then you move into a more expensive house. You take more expensive vacations. You upgrade everything. And suddenly your annual expenses are much higher. This is called lifestyle inflation, and it can quietly delay financial independence. Imagine your portfolio reaches $500,000. You decide that you've made it, so you increase your annual spending by $20,000. That doesn't only mean spending $20,000 today. That money could have remained invested and potentially compounded for years. This doesn't mean you should never enjoy your wealth. That's not the point of building wealth. Money should improve your life. The goal is to make your spending intentional. Instead of asking, "Can I afford this?" ask, "Does this purchase actually improve my life enough to justify its long-term cost?" There's a huge difference between spending money because you value something and spending money simply because you can. 9. $500,000 can be you something more valuable than stuff. What can money really buy? A bigger house? A luxury car? Expensive vacations? Yes. But arguably, one of the most valuable things wealth can provide is time. Imagine you have $500,000 invested in relatively controlled expenses. Maybe you can take several months away from work. Maybe you can reduce your working hours. Maybe you can move to a lower cost location. Maybe you can choose a less stressful career. Maybe you can spend more time with your family. Maybe you can start a business without worrying about making money immediately. That's the deeper meaning behind financial independence. Eventually, wealth becomes less about buying more things and more about controlling more of your time. Think about it. You can always earn another dollar, but you can't earn another hour. Once an hour is gone, it's gone forever. That's why many people who pursue financial independence aren't actually chasing luxury. They're chasing freedom of choice. And reaching $500,000 can be a major step toward that freedom. 10. The HE game changes. BUTIT doesn't end. So, what really happens when your investments reach $500,000? You don't magically become rich. You don't become immune to market crashes. You don't automatically get to retire. And you don't suddenly have a guaranteed path to $1 million. But something important does change. The mathematics change. Your portfolio is now large enough that normal market movements can create meaningful dollar amounts. Compounding can become much more powerful. Your financial cushion can become stronger. Your dependence on your paycheck can potentially decrease. And your choices can expand. But perhaps the biggest change is psychological. You realize, I built this. You learned how to save. You learned how to invest. You learned how to control your spending. You learned how to survive market volatility. You learned patience. You learned discipline. And you discovered that wealth isn't normally created through one incredible decision. It's created through thousands of ordinary decisions repeated over many years. So if you're currently at $5,000, don't worry about being at $500,000. If you're at $50,000, keep going. If you're at $100,000, keep going. Because the journey isn't just about reaching a number. It's about becoming financially stronger at every stage. And once you eventually reach $500,000, you may discover something surprising. The goal isn't simply to have more money. The goal is to create enough financial strength that your money gives you choices. Choices about where you work. Choices about how you spend your time. Choices about what risks you take. And choices about what kind of life you want to build. So don't focus only on the destination. Focus on building the habits that can get you there. Save consistently. Invest for the long term. Avoid unnecessary debt. Keep learning. Stay patient. And give compounding the one thing it needs most: time. If you enjoyed this video and want more practical content about investing, wealth building, financial independence, and money psychology, like this video, leave your thoughts in the comments and subscribe to Finance with Brad. And remember, your first $100,000 teaches you how to build wealth, but reaching $500,000 can show you just how powerful that wealth can become. Until next time, keep learning, keep investing, keep building, and keep taking control of your financial future.